Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help people get better returns in the stock market. We're here with Robb Fahrion of Flying V, our marketing partner and consistent host. Robb, how are you this week?
Doing great. Happy Monday, Gary, or Tuesday, whenever someone may be viewing and listening to this. How's it going for you?
Good. I'm actually in Manhattan today,
Okay,
visiting with Raji Kabaz, one of the members of Deep Knowledge Investing's board of advisors, my former partner and co-portfolio manager from Silver Arrow. So we've just been hanging out, getting some good food here in New York and working.
great. Please tell Raji I said hello.
Yeah. All right. I
Uh,
couldn't get him on this version of the five things though. We're gonna have to do that
next
another week.
time,
Yeah.
next time. I think it's only a matter of time before you have a guest or two for sure.
Yeah.
Change it up
Perfect.
on people.
Yeah.
So this week, Gary, jumping into it, a consistently inconsistent theme. The super duper inconsistent data issue. Today, we're going to be talking about fourth quarter GDP, S&P, manufacturing and services PMI. We got some updates on LVS as well. Ready to go?
Yeah, and just so it's clear, the data is inconsistent. So over the next, 20 minutes or so, as Rob and I go through this week's five things, expect that I'm going to contradict myself. We're going to contradict ourselves multiple times. That's not us not knowing what's going on. It's the data really is that confused. It's something we've been pointing out every week in the month of January, and that's the theme. We're going to keep going with that.
The one thing that stuck out to me is that it almost as if it's designed to be misunderstood. So we'll carve through that and do the best we can. Point number one, jumping right into it for this week's five things. Fourth quarter GDP came in well above expectations. Gary, tell us all, is it real?
Yeah, it's not real. First of all, the number itself was startling. Fourth quarter GDP was reported, and I am emphasizing that word reported, at up 3.3%. That was above expectations of 2%. Just so you guys know, the expectation, the estimate that people have, I mean, people usually have a pretty good beat on these things, and the estimate tends to be right to within a tenth of a percentage point. If they're really, really off, 0.2%. For the analyst community to be at 2% and have the number come in at 3.3%, 1.3% higher, is an error of enormous proportions. These kinds of mistakes are not made in that size. And so here's what I think is going on. First of all, the market loved the print. Who doesn't want to be in an economy that's growing? But it was entirely created by government spending. So just to give you a sense, GDP, gross domestic product, grew by about $1.5 trillion. Okay, sounds fine, right? But debt in that time, government debt grew by more than $2 trillion. Okay. So to give you a sense, and just we've talked about this before, government spending adds to GDP whether it creates value or not. If the government pays half the country to dig holes and the other half of the country to fill in holes, we've created no economic value, but all of the money that they pay people gets added to GDP. It's one of the ways that they lie to us with the economic statistics. But let's use a really good analogy here. So let's imagine, Rob, what's the average American make in income? About maybe $60,000, something like that?
Yeah, I would have guessed somewhere around there, maybe even a little bit less. Yeah,
All
50,
right.
60,000. I think you're
All
right in the
right.
wheelhouse.
I'm estimating. And if I'm wrong, feel free to correct me in the comments.
Put it
It's
in the
fine.
comments and let Gary know.
Yeah, exactly. All right. So, but let's imagine that's the case. And now let's imagine that, during a particular quarter or a particular month, you max out your credit cards and run up $20,000, $30,000 of credit card debt, right? And you get to spend all that money and you count that as income. And so you say, oh, wait, I ran up $30,000 in credit card debt this quarter. So what I have is my regular income plus another $120,000, and I'm making almost $200,000 a year, and I'm having a fantastic year. And yeah, you get to spend that money in that hypothetical example. You get to spend that $30,000, but it's not really income. It's not really production. You just run up a giant credit card bill. And so when you have GDP up by 1.5 trillion, but debt up by 2 trillion. What that's telling you is that the government is manufacturing their number. And it takes more than $1 of government spending to create a dollar of actual value here. The other thing, and this is something that Mish Shedlock, Michael Shedlock, who goes by the mononym Mish, he's our resident economist on the Deep Knowledge Investing Board of Advisors. But last year, he spent the whole year pointing out the huge difference between GDP and GDI. So gross domestic product, that is the sum total of the goods and services produced by Americans, over time has to match gross domestic income. That's the income earned by Americans, right? Production and income, they have to match over time. And what we've seen is that the GDP number is very high and the GDI number is very low. And you tell me which one you think is going to be adjusted to sort this out, right? It's going to be the GDP because people are reporting their income. So if the income is below gross domestic product, the difference in this case is well, let's just say it's something that if you and I were to do this kind of accounting in our business, it would be considered fraud. But because it's the US government, we're not going to call it fraud, right? So just for clarity, we are not accusing the US government of fraud. Fraud is the thing we are not accusing anybody of because we couldn't do this, right? You see,
is there any adjustment, Gary, based on the GDP to where, okay, what those dollars are actually being spent on, right? To where when we talk about the American consumer, okay, are they spending their money on things that may be frivolous, entertainment, etc., versus using that credit towards something else that may be looked at as an investment or some type of long-term potential?
Yeah, so what we're seeing is over the last couple of years, there's been a huge shift from goods to services. Now, some of that frivolous, maybe, I don't know, should people be spending $1,000 on Taylor Swift tickets? The answer is maybe if you have that kind of money. If you need to take on credit card debt, then maybe that's not a good idea.
Right.
But there's definitely a shift from goods to services. And, for people wondering, okay, great, you're questioning the numbers, but what does all of this mean? The answer is that with GDP this high, that strong print makes it less likely that the Federal Reserve will lower interest rates at the next meeting. It also gives some strength to the arguments being made by people saying we're heading for a soft landing, which is a reduction of inflation without a recession. Again, if Congress is going to keep throwing money at it, we will technically not enter a recession, but we will all pay for this through more inflation. Right. And all of that will make it, again, harder for the Federal Reserve to pivot to lower rates, which is what the market is hoping for. The market's penciled in, I think, 6 rate cuts for this year. Each rate cut is considered 25 basis points or 0.25%. So Wall Street is pretty much expecting a reduction of rates this year by the Federal Reserve by about 1.5%. My guess on it, and it's not a guess, my estimate is that we're going to take the under on that. I think when we get to the end of the year, the Federal Reserve will have reduced rates by less than that. And if I'm wrong, it will be because we've entered a recession. And if that's the case, that's not going to be good for stock prices.